Imagine waking up one morning to find your trading account down 30% because you made decisions based on emotions rather than strategy. This happens to thousands of traders every single day, and the worst part is that it's completely preventable. The difference between traders who consistently make money and those who blow up their accounts isn't luck or some secret indicator. It's having a solid trading plan and actually following it. Most people jump into trading thinking they can wing it, but without a roadmap, you're just gambling with your hard-earned money. Let's talk about what separates successful traders from everyone else. Professional traders treat trading like a business, not a hobby or a lottery ticket. They have systems in place, they know their risk tolerance, and they stick to their rules even when their emotions are screaming at them to do something different. If you've ever bought a stock because everyone on social media was talking about it, or sold in a panic when the market dipped, you already know how powerful emotions can be. A trading plan is your defense against making those costly mistakes. So what exactly is a trading plan? Think of it as your personal rule book for trading. It covers everything from what markets you'll trade, when you'll enter and exit positions, how much money you'll risk on each trade, and what you'll do when things go wrong. It's not just a loose idea in your head. A real trading plan is written down, detailed, and specific enough that someone else could follow it and execute trades the same way you would. The first step in building a trading plan is getting brutally honest with yourself about your goals. Why are you trading in the first place? Are you looking to build wealth over decades, generate income to supplement your job, or maybe even trade full-time eventually? Your goals will shape every other decision you make. Someone who wants to grow their retirement account over 30 years is going to trade very differently from someone trying to make $500 a week in cash flow. Write down your specific financial goals with actual numbers and time frames. Instead of saying you want to make money, say something like you want to grow your account by 15% annually over the next 5 years. Next, you need to understand your risk tolerance. This is where most people lie to themselves. They think they can handle big swings in their account value until they actually experience a losing streak and panic. Risk tolerance isn't just about how much money you can afford to lose. It's about how much loss you can handle emotionally before you start making irrational decisions. Some traders can watch their account drop 10% and sleep fine at night. Others get stressed with a 3% drawdown. Neither is wrong, but you need to know which one you are. Here's a practical way to figure this out. Think about an amount of money that if you lost it tomorrow, you'd be upset, but it wouldn't change your lifestyle. Maybe that's $500, maybe it's $5,000. That gives you a baseline for how much total capital you should be risking across all your positions at any given time. Most professional traders never risk more than 1 to 2% of their total account on a single trade. So if you have a $10,000 account, you're risking only $100 to $200 per trade. This might sound overly conservative, but it's what keeps you in the game long enough to become profitable. Now let's talk about choosing your markets and instruments. The trading world is massive. You've got stocks, options, futures, forex, cryptocurrencies, and more. Trying to trade everything is a recipe for mediocrity. Instead, pick 1 or 2 markets and become an expert in them. If you're interested in stocks, are you going to trade large cap companies, small cap growth stocks, or dividend paying stocks? Each has different characteristics and requires different strategies. Your time availability matters here too. If you have a full-time job, you probably can't day trade stocks that require you to watch screens all day. You might be better suited for swing trading where you hold positions for days or weeks, or even position trading where you hold for months. Be realistic about how much time you can dedicate to research, monitoring positions, and executing trades. A trading plan that requires 4 hours a day won't work if you can only spare 4 hours a week. Once you've chosen your markets, you need to define your trading strategy. This is your method for finding and executing trades. There are countless strategies out there like trend following, mean reversion, breakout trading, and value investing. You don't need to invent something completely original. Many profitable traders use well-known strategies but execute them with discipline. What matters is that you understand the logic behind your strategy and can explain why it should work over time. Let's say you decide to trade trend following strategies in stocks. Your plan should specify exactly what qualifies as a trend in your book. Is it when a stock is above its 50-day moving average? When it makes a series of higher highs and higher lows? Get specific. Your entry rules might say you'll buy when a stock breaks above a resistance level on higher than average volume after being in an uptrend for at least 3 weeks. That's concrete and testable. Exit rules are just as important as entry rules, maybe even more so. This is where emotions really try to take over. When a trade is winning, greed whispers that you should hold longer to make even more. When it's losing, fear tells you to get out immediately, or hope tells you to wait for it to come back. Your plan needs to tell you exactly when to exit before you enter the trade. Will you use a specific price target, a trailing stop that moves up as the stock rises? A time-based exit exit where you close the position after a certain number of days regardless of profit or loss? Most successful traders use a combination of exits. They might have a profit target where they take money off the table, a stop loss to limit damage on losing trades, and a time stop to get out of positions that aren't working. A good rule of thumb is to aim for trades where your potential reward is at least twice your risk. If you're risking $100 on a trade, you should be targeting at least $200 in profit. This way, you can be right less than 50% of the time and still make money. Stop losses deserve special attention because this is where discipline really gets tested. A stop loss is a predetermined price where you'll exit a losing trade to prevent further damage. When you set a stop loss, you're making a calm, rational decision about the maximum you're willing to lose. But when that stop is about to be hit, every emotional fiber in your body will try to convince you to give the trade more room or that it will turn around if you just wait a little longer. This is how small losses become catastrophic ones. Your trading plan should specify exactly where you'll place stops and commit you to honoring them no matter what. Some traders use technical levels, like placing stops just below a support level. Others use volatility-based stops that adjust based on how much a stock typically moves. Whatever method you choose, write it down and treat those stops as sacred. The moment you start moving stops further away to avoid taking a loss, you've abandoned your plan and you're gambling. Position sizing is another critical component that doesn't get enough attention. This determines how many shares or contracts you'll trade based on your account size and risk per trade. If you're risking 1% of a $10,000 account, that's $100 of risk. If your stop loss is $2 below your entry price, you can buy 50 shares. If the stop is 50 cents away, you can buy 200 shares. This ensures you're risking the same dollar amount regardless of how far your stop is from your entry. Many traders make the mistake of always trading the same number of shares. They might always buy 100 shares whether the stop is close or far away. This means they're taking wildly different amounts of risk on each trade, which leads to unpredictable results. Proper position sizing keeps your risk consistent and helps you survive the inevitable losing streaks. Let's talk about those losing streaks because they will happen. Even the best trading strategies lose money 40 to 50% of the time. You might hit a stretch where you lose 5 or even 10 trades in a row. This is statistically normal, but it feels terrible. Your trading plan needs to address how you'll handle drawdowns. Will you reduce your position size after a certain number of losses? Take a break from trading? Review your strategy to make sure nothing has changed? Having these rules in place before you're in the middle of a losing streak is crucial. When you're down and frustrated, your judgment is compromised. You might be tempted to increase your position sizes to try to make back losses quickly, which is exactly how accounts get blown up. Your plan should probably say something like, if you lose more than a certain percentage of your account, you'll reduce your position sizes by half and review your recent trades to identify any mistakes. Record keeping is unglamorous but essential. Every trade you make should be logged with details about why you entered, where you placed your stops and targets, how you managed the position, and why you exited. Over time, this journal becomes incredibly valuable. You'll start to see patterns in what works and what doesn't. Maybe you notice you make your best trades in the morning but struggle in the afternoon, or that you perform better with certain setups than others. Without records, you're flying blind and can't improve. Your journal should also include notes about your emotional state and anything unusual happening in your life. You might discover that you make poor decisions when you're stressed about work or after staying up too late. These insights help you understand yourself as a trader and can lead to rules like not trading on days when you're sleep deprived or particularly anxious. Backtesting is how you build confidence in your strategy before risking real money. This means applying your trading rules to historical market data to see how they would have performed. If you're trading stocks, you can go back through charts and identify all the setups that matched your criteria over the past few years. Then track what would have happened if you followed your exit rules. Did the strategy make money overall? What was the win rate? What was the largest losing streak? Backtesting isn't perfect because past results don't guarantee future performance, and you can't perfectly replicate the emotions of real trading, but it does give you a statistical foundation. If your strategy would have lost money consistently over the past 5 years, it's probably not going to magically work now. On the other hand, if it showed consistent profits with manageable drawdowns, you can start paper trading it with more confidence. Paper trading is practicing with a simulated account that tracks real market prices but doesn't use real money. Most brokers offer this feature. It's a step between backtesting and live trading that helps you get comfortable with execution. You'll practice entering orders, managing positions, and following your rules without the emotional intensity of real money being at stake. mistake. Spend at least a couple of months paper trading your strategy successfully before moving to real money. When you do start trading with real capital, begin small. Even if you have $50,000 to trade with, start with just a few thousand. The psychological difference between paper trading and real money is enormous. That first time you watch your actual money fluctuate, emotions you didn't know you had will surface. Starting small gives you a chance to experience those emotions and stick to your plan without catastrophic consequences if you struggle. Your trading plan should also cover how you'll continue learning and adapting. Markets change over time. Strategies that worked beautifully for years can stop working as market conditions shift. This doesn't mean you should abandon your plan at the first sign of trouble, but you need a process for evaluation. Maybe once a quarter, you'll review your results and look for any significant changes in performance. If something has clearly broken, you'll take a break from trading that strategy and investigate what changed. Education should be ongoing. Successful traders read books, take courses, and study the markets constantly. But here's a warning. There's a trap of perpetual learning where people spend years consuming content but never actually trade. They're always waiting to learn just one more thing before they risk real money. Your plan should balance education with action. Maybe you commit to reading one trading book per month, but also to executing your strategy consistently. Let's address something uncomfortable. Most people who start trading lose money, especially in the first year or two. This isn't meant to discourage you, but to set realistic expectations. Your trading plan should account for this reality. Maybe you decide you're willing to lose a certain amount as tuition for learning to trade. Once you hit that number, you'll pause and honestly assess whether trading is for you. This prevents the scenario where someone keeps throwing money at trading year after year without ever becoming profitable. Your plan should also specify rules about when you'll increase your position sizes and risk. Many traders make the mistake of increasing size too quickly after a few winning trades. A more sustainable approach is to increase gradually as you prove consistent profitability over a meaningful period. You might decide that once you've been profitable for 6 consecutive months and your account has grown by 20%, you'll increase your risk per trade from 1% to 1.5%. This ensures you're scaling up based on demonstrated skill, not just a hot streak. Life circumstances should factor into your plan too. What happens if you need to withdraw money from your trading account? If you have a major life event like a wedding baby or job change, your plan might say that you'll reduce position sizes proportionally if you withdraw capital to maintain the same risk levels, or that you won't trade for a month around major life events because your focus will be divided. Technology and tools deserve mention. What platform will you use for charting and execution? What tools do you need to implement your strategy? If you're tracking moving averages and volume, make sure your platform can display these clearly. If you're using more complex indicators or running scans for specific setups, you might need more sophisticated software. Write down what tools you're using and how you're using them so you're consistent. Risk management extends beyond individual trades. You should also have rules about total exposure. Maybe you'll never have more than 30% of your account in positions at once, keeping the rest in cash. Or you won't hold more than 5 positions simultaneously because you can't effectively monitor more than that. These portfolio-level rules protect you from correlated risks where multiple positions move against you at the same time. Let's talk about mindset and routine. Successful trading requires emotional regulation and mental discipline. Your plan can include routines that support this. Maybe you start each trading day by reviewing your plan and your open positions. You might avoid checking your account obsessively throughout the day if you're a swing trader. You could have a rule about not trading when you're angry, hungry, tired, or otherwise emotionally compromised. Some traders benefit from having rules about discussing their trades. Talking about open positions on social media or with friends can introduce outside opinions and social pressure that clouds judgment. Your plan might say you'll only discuss trades with a specific trading partner or mentor, or not until after they're closed. Here's something many plans overlook, but is incredibly important. Define what success looks like and how you'll measure it. It's not just about making money. You might measure consistency, win rate, average gain versus average loss, maximum drawdown, or how well you followed your rules. Sometimes the best month is one where you made less money but followed your plan perfectly. That's more predictive of long-term success than a lucky month where you broke your rules but happened to make money anyway. Your plan should be a living document. Write it down in detail, but review and refine it as you gain experience. After your first year of trading, you'll know so much more about yourself and the markets than when you started. Update your plan to reflect that knowledge, but be careful not to change it too frequently or in response to emotions. emotions. If you're tweaking your plan every week because last week's trades didn't work out, you're not following a plan, you're chasing results. Finally, let's address the hardest part of having a trading plan, which is actually following it. You can have the most brilliant plan ever written, but it's worthless if you don't execute it consistently. This is where most traders fail. They have a plan, but when faced with real-time decisions and real money, they second-guess themselves or give in to emotions. Building the discipline to follow your plan takes practice and often requires external accountability. Some traders work with coaches or trading partners who help them stay accountable. One technique that helps is to visualize following your plan before the trading day starts. Mentally rehearse entering trades according to your rules, managing them properly, and taking stops without hesitation. When the actual moment comes, your brain has already practiced the correct behavior. Another approach is to make following your plan a bigger priority than making money. For your first several months, measure your success by how well you stuck to your plan, not by your P&L. The profits will come if you can master consistency first. Building a trading plan that works for long-term success isn't complicated, but it requires honesty, discipline, and patience. It means accepting that trading is a skill that takes time to develop and that losses are part of the process. It means treating trading like a serious business with rules and procedures, not like entertainment or gambling. Most importantly, it means committing to following your plan even when it's uncomfortable, even when you're scared, and even when you think you know better in the moment. The traders who make it are the ones who have a solid plan and the discipline to execute it trade after trade, year after year. That's how you build lasting success in the markets.